Now, I have to say a few things in preparing to put forward my recommendations about the Fed's ordinary operating framework. This framework is based largely on open market operations, that is, the Fed's selling and buying, mainly buying, of securities in the open or secondary market. Now, the particular setup the Fed relies on for its open market operations consists of two important components. The first is the so-called primary dealer system. This system consists of a set of specially privileged banks. There were 20 on the eve of the financial crisis. There are 21 now. And it deals in its open market operations usually only with these special institutions. That's one feature of its operating framework that I intend to criticize. The second feature is the Fed's so-called treasuries-only policy, which Jeff Lacker referred to very briefly. That is, its policy of limiting its open market purchases to purchases of U.S. Treasury securities only. Now, it is by open market purchases and occasional sales of Treasury securities that the Fed engages in ordinary monetary policy, that is, policy aimed at regulating the supply of money in the economy in normal times and achieving the Fed's policy targets, including its intermediate interest rate targets. The Fed also operates a discount window facility, and this facility is specifically for last resort lending purposes. And here it engages through the discount window loans in direct lending to particular individual financial institutions on the basis of collateral specified in its discount window policy, and that collateral can include lots of things other than Treasury securities. Now, some people have argued that in our modern financial system, there's no reason to have a discount window. In fact, there was quite a few of these arguments being made prior to the recent crisis, and the rationale behind them was fairly straightforward. In our modern financial system, we have a well-developed private market for allocating credit. We have the federal funds market where banks lend reserves to each other overnight, and we have other wholesale lending markets. So in principle, if the Fed gets the total amount of liquid funds right through its open market operations, we can rely on the private marketplace to allocate the funds where they are most needed. Therefore, there should never be any need for a discount window facility because banks that are sound but in need of liquidity should be able to acquire it in the open market using good collateral in conformity with Bagehot's principles, provided that the Fed sees to it that the aggregate amount of liquidity in the economy is sufficient. Well, of course, the recent crisis has cast a lot of doubt on this view. Many people questioned it before, but it is now more widely believed that, of course, in a time of crisis, you can't rely on secondary markets and private institutions to allocate aggregate liquidity effectively, that there must be some direct lending by the Federal Reserve. I propose to argue that this is an incorrect conclusion to draw from recent experience. The fault doesn't lie with the inadequacy of open market operations as such. The problem is the Fed's particular framework for implementing such operations. The problem is the primary dealer system on one hand and the Fed's treasuries-only policies on the other. These are the reasons why open market operations have not been or were not perceived to be adequate by themselves during the recent crisis, but modifying these elements of the Fed's operating framework should suffice to allow the Fed to manage money with open market operations alone and to see to it that solvent firms are never short of liquidity. Now, what's the theory behind the existing framework? In particular, what's the theory behind the primary dealer system? Well, it's premised on the assumption that primary dealers are the soundest of sound financial institutions. Come on, laugh. And the idea is that by dealing with only these especially sound institutions, the Fed protects itself from any sort of counterparty or credit risk, and then they can take responsibility for acting as conduits to get funds they acquire from the Fed to other financial institutions that are in need of them. But of course, the theory breaks down if primary dealers are themselves in trouble. It breaks down for two reasons at least. One is that now the counterparty risk problem is a problem that causes other financial institutions to be leery of dealing with primary dealers. That's one part of the problem. The other part is that primary dealers can now engage in liquidity hoarding as a way to deal with their own balance sheet problems. So instead of being efficient monetary policy conduits, they become so many gigantic liquidity sponges. That is, in a nutshell, my paper goes into the details, what happened, or a part of what happened after during 2008. Now, the Fed's response to the breakdown of the primary dealer system was to turn from its mission of maintaining the liquidity of the solvent component of the financial market to instead devoting its efforts to rescuing the primary dealers, with a notable exception of Lehman Brothers. And it financed its rescues of these primary dealers, which were undertaken through various new facilities, including the primary dealer credit facility and the term securities lending facility. It financed these rescues by actually depriving the solvent financial market of liquidity. This is, of course, what was referred to previously as its policy of sterilized direct lending. The discount window, by the way, didn't help. The discount window didn't help because banks, rather than turn to it, resisted doing so, because there has been, since continental Illinois, a big stigma attached to discount window borrowing. The Fed thus had to respond with another facility, the term auction facility, which was a kind of temporary bypass of the primary dealer system and also of treasuries only, that operated as sort of a hybrid between open market operations and direct lending, because funds in predetermined amounts were auctioned off to the highest bidders, to banks that bid for them. And this bidding process avoided the stigma that direct discount window lending might have involved. So, in short, you had all kinds of ad hoc emergency lending facilities that arose as a result of the breakdown of the Fed's operating system, and particularly of the primary dealer system. Now, these responses, though, were far from satisfactory. First of all, they failed to prevent a severe freeze of liquidity in late 2008, and that's the event that I believe marked the transition from a mere financial crisis — mere is not exactly the right word for it — but from a financial crisis to a recession. The arrangements contributed to the propping up of insolvent firms through subsidized last resort loans. They reinforced the dogma that some financial firms are too big to fail. And finally, they set the stage for further, perhaps even more severe, excessive risk-taking by such too big to fail enterprises. All right, so my Bagehottian prescription for the 21st century. First, end the primary dealer system. That primary dealer system is, first of all, a farce. The primary dealers are not the soundest of the sound financial institutions. They are more like the most rotten of rotten financial institutions. Second, they are an anachronism. The system first arose because it was literally necessary for the Fed in New York to collect paper slips from firms making bids. That's why all the primary dealers had to be in New York. It is a horse and buggy arrangement. With our modern computer technology, it's perfectly possible for auctions to be held with hundreds, even thousands of separate institutions that could be located anywhere in the world or in the country. In fact, the ECB has 500 counterparties it routinely deals with for its open market operations, and it's legally able to deal with more than twice that many. Now, I'm the last one to say that the ECB is a particularly enlightened central bank. Politics are behind this, of course, the fact that there are many countries and they all should have a fair share and so on. Nevertheless, it's a more sensible and more modern arrangement. Second, treasuries only should be abandoned. This is treasuries only, the Fed's treasuries only policy is based on the rationale that treasuries are the only safe securities the Fed can deal in, and that the Fed doesn't want to favor any particular private market enterprises by allowing their securities to be routinely purchased by it in open market operations. But we should go back to the original Federal Reserve to see how unnecessary this treasuries-only policy is, in fact, and how easy it is to show that it doesn't have a sound foundation. In the original Federal Reserve Act, the Fed was not supposed to be routinely buying Treasury securities at all. In fact, the fear then was that by having the Fed buy Treasury securities, you would invite, well, guess what? The monetization of debt. So the whole idea was, let's have a no treasuries policy so we don't have this kind of debt monetization. Now, for various reasons, that broke down under pressure from the Treasury in part, and indeed the result was that the Fed played handmaiden to the Treasury for much of its history. And one can argue whether the Treasury Accord of 1951 really put an end to that. The Vietnam War experience suggests otherwise. Recent experience, I think, suggests otherwise as well. So there is a problem with buying treasuries, too. It's not as if treasuries are a perfectly safe asset for the Fed to deal with no problems behind them. Now, another argument for not having the Fed engage in purchases of non-treasury securities is that, of course, it would be favoring those institutions whose securities it agreed to purchase, private institutions, private issuers. This reminds me of the old anti-Jackson pet banks argument, right? We must have a Bank of the United States because otherwise, wherever the government puts its deposits, it'll be favoring those pet state banks. Well, if the government only put its money in a federal bank, then that's one giant big pet bank, isn't it? So the Treasury here is the pet of the Fed as long as only its securities are allowed. Besides, the Fed could certainly come up with a list of securities that is objective in the sense that it's based on credit ratings or other things, just good investment grade, whatever. This is what the ECB does because it also doesn't have a treasuries-only policy. Here's the thing. If you make these two changes, in principle, any financial institution with good collateral that doesn't have to be treasury securities can always get in line and participate in an auction and get its share of liquidity directly from the Fed, not through a primary dealer conduit that might break down. And this is, I submit, the 21st century counterpart of Bagehot's advice for the 19th century. It is a simple way to have a central bank operating system that can always see to it that liquidity goes where it's needed and can do so either in crisis or in non-crisis times without any ad hoc changes in the rules, without any emergency lending vehicles, and so on. Finally, I propose that once all these other steps are taken, that the direct lending by the Fed be stopped once and for all. Everything is auctions. Everything goes to the highest bidder, and so on. The discount window can be closed once you get rid of the primary dealer system and treasuries only. Now, finally, a last word about me and old Walter Bagehot. Bagehot saw his recommendations in Lombard Street in 1873 as substitutes for going to a natural system, a free banking system. I don't see these proposals I'm making today that way. I see them as stepping stones. I believe that once we can exclude direct lending from the Fed's mandate, once we reduce everything to open market operations based on unchanging rules, that is our first step towards an overall Federal Reserve constitution that would abolish all kinds of monetary discretion. And I think eventually that would mean disbanding the FOMC and having an automatic Fed that is run by a computer or something like it, where we no longer have to worry about central bankers coming up with new clever ideas. Thank you very much.